Thank you very much. I'm Kathy Keeley and the Executive VP here at the Georgia Center. And I am one of those people that's a trained social worker and somewhere along the line figured out I was really good at numbers. And I love doing spreadsheets. I love the financial side. And in the nonprofit world, you really have to be able to tell your financial story. We're now scored, rated. You can be a bronze or a silver or a gold. I mean, there are charity groups out there watching, there are donors. So it's really important for you to understand how to tell this financial story. And we are very lucky to have Marshall Jones with us and a longtime partner. I've dragged Randy into a few projects of mine. So we cross-refer all the time. And he's got with him Nathan and Greg, who are also at Marshall Jones and all specialized in auditing and financial preparations for nonprofit organizations. And they have a presentation. Each of them is going to present on a specific topic and walk us through. So with that, Randy, yours. Welcome.
Well, thank you, Kathy. Good afternoon, everybody. Here's our topics, our agenda. I'll be taking the first two and then handing over to Greg for the third about budget preparation. And then Nathan will be taking us to the end, talk about the importance of graphs and ratios and how they can help with telling your financial story. So the next slide, please. So as members of the Georgia Center for Nonprofits, we all know that nonprofits are different, but our board members may not. They may think that the nonprofit financial statements are just the same as a for-profit financial statement. But we know the focus and the emphasis are going to be different because with nonprofits, it's all about the mission, programs, and serving the community. Next slide, please. It is crucial for board members to realize that they are responsible for the well-being or the organization that they serve. And we're seeing the current landscape of increased accountability for accuracy and integrity, heightened expectations of boards to be informed, transparent, effective, and then the media coverage we're all seeing out there. Perhaps maybe even you can think about organizations such as Wounded Warrior Project, United Way, the NRA, Boy Scouts. Well, these disclosed lapses of judgment and failures of integrity have heightened the concerns about reputational risk. And I really like this next slide. It's got a quote here from Warren Buffett. We've probably seen this before, but it's good remembering that it takes 20 years to build a reputation and just 5 minutes to ruin that. So I think if we keep that in the front of our minds, we're really going to be doing things differently. And here, kind of as a starting point, let's think about who we'll be communicating to our financial story. We know there's going to be the full board or a committee of the board. It's going to be management. And these first three, we're going to be talking about more in the next couple slides. It could also be our staff or volunteers, or maybe externally, it's going to be our customers of our mission, donors, grantors, banks, the government, media, or even the general public, which could include watchdog agencies. Next slide, please. And we know there are barriers to understanding, such as time, willingness, and ability. There's complex information. This nonprofit accounting is unique, and that's actually going to be the second topic here I'm going to be going through. There could be a lack of experience with non-for-profit financials. Even with our board members that are familiar with financials of for-profit companies, there may be a difficulty there. So this is really why the method of the communication is going to be key, because most will have a passion for the mission, but they may have a fear of the financial information. Next slide, please. So those charged with governance, or it can be defined as any of the following committees of your board of directors, could be the audit, the finance, or the executive committee. We want to make sure that they are exercising their financial stewardship and transparency. Make sure that they're knowledgeable about the financial reporting process. Do they have the skills, background, knowledge, and experience to add value during their oversight of the financial reporting process? Are they engaged by asking questions? Are they reading the materials? And are they presented the information with the desired level of detail that they want to see? So what is their communication style? Because we need to adapt to them, not the other way around. And here, responsibilities of management, they're going to be the ones actually preparing the financial statements. under the oversight of those charged with governance. And we think about financial statements, after they're prepared by management, there actually you could engage an outside CPA to perform 3 levels of service. One would be a compilation. What that is, the outside accountant will actually read your information and prepare a financial statement for you, but there's really no assurance given on a compilation. Second could be a review. That means the outside accountant is going to be preparing inquiries, analytical procedures, and there's going to be some limited assurance there. And then finally, it could be an audit. We actually have an independent auditor. They're going to confirm your cash and other balances, detail test source documents, obtain an understanding of internal controls, and really it's about a 95% assurance that they're going to provide. And then management's also going to be establishing, maintaining effective internal controls over the financial reporting process, and then finally making those records and related information available so that the board can do their job and take any corrective action that may be needed. Next slide. So financial reports, we know that this is going to help us tell where the organization's headed. It's going to help you tell your story, and it's going to be the key to exercising financial leadership. Next slide. Here, Marshall Jones recommends the following steps to help you present financial information to non-accountants. First, provide the timely information prior to the scheduled meeting. And that means, not the day of, not the evening before, but give them a couple days to actually review the information that's provided. Second, highlight information you want them to focus on. And you can actually use colors here, or maybe use bullet style text, but always make sure you're presenting the most important information first. Then utilize understandable elements and layman terms. Maybe you're presenting financial information and there's columns. We recommend using between 2 and 4 columns. More than 4 is really going to be too much to follow. If you only have 1 column, you're really going to force people to remember what you've had maybe on a prior slide or a prior period. And here, we always want to be able to present comparable information to make it as understandable as possible. And then reduce to as much of a simple level as needed. Here, less is more, and we recommend using minimum text. Be sure we're not over-explaining. We want to stop for questions. Here, we like to provide that traditional detailed statements. You can provide it as a supplement in the back in case there are questions or maybe more advanced board members that do understand the nonprofit accounting, but just make it available as needed. And then finally, focus on cause and effect. Use personal examples or stories. For example, we're going to be talking about the liquidity footnote, and some people may say, why is this important? Why do we need to know this? Well, you could use a story such as, without sufficient liquidity, a nonprofit may defer spending decisions, they may have to cut programs, or sell long-term assets to settle current debts. Next slide, please. And there's other presentation tips. I've actually had a nonprofit before have a briefing call, like a for-profit entity would, where they encourage discussion and strategies. They talk about achievements and challenges, and then they go over the financial and operational performance indicators and trends. We also recommend considering a management discussion and analysis. Now, this would be an unaudited part of your financial statements presented in advance of the auditor's statements, but these are really your financial statements. And this will be the first thing the reader sees, and they can tell your story this way. And to be effective, you can use a broad overview here of telling your story first, putting the most important items first, and utilizing primarily charts and graphs that will help the user understand the information. And Nathan's actually going to be talking about that a little bit later on. Next slide. Where we start the second aspects of our agenda this afternoon. Here we're going to talk about the unique aspects of non-for-profit accounting. I'll just caution that these slides may appear like you're attending a college accounting course, but it's not intended that. It's really meant to be as a resource to help you instruct your board members, and so they can see how different non-for-profit accounting is from regular corporate accounting. This is going to include the provisions of ASU 1614, which is called the Financial Accounting Standard Board's Auditing Standards Update 1614. It talks about this unique financial reporting for non-for-profits. And this standard is about 3 years old now, but it really need to communicate how much this now requires very unique financial reporting for not-for-profits, because this is not in any way similar to for-profit companies. And the main provisions here are about net asset classification. There's going to be 2 parts of equity, either with or without donor restrictions. It now requires a statement of functional expenses. This is where you're going to allocate expenses by function and by natural categories. And then finally, it's got this brand new concept of liquidity and availability. And we're going to be talking about that now in the next slide. Because we know cash is king, right? Greg's going to start after me and talk about the importance of budgeting and cash flow projections. But so management and the board must also fully understand the importance of liquidity and availability of resources. This is why this is now a required disclosure for non-for-profits. Business leaders may not be aware of this disclosure because it's only required for non-for-profit entities. And this disclosure is going to require 2 elements: the qualitative nature of your liquidity and the quantitative nature. Qualitative is defined here, and I'll just read it. It says it's information to the notes to the financial statements that is useful in assessing the entity's liquidity and that communicates how a nonprofit manages its liquid resources available to meet cash needs within 1 year of the date of statement of financial position or balance sheet. And we're going to be talking about examples here, but the next slide is a good way to talk about quantitative, this quantitative disclosure example. You're going to start with your financial assets, your cash, accounts receivable, investments, and then you deduct unavailable assets that would be unavailable within the next year. And that could be contributions or accounts receivable collectible beyond 1 year, or maybe there's board designated endowments. And you end up with this net financial assets available to meet cash needs for general expenditures with 1 year. And the usage statements are just going to see this number. So what does this number really mean? What I like to do is, we talked about that new statement of functional expenses. Take that statement and determine how much the organization has spent per day. So you deduct things non-cash like depreciation and see how many days expenses this number actually represents. And that'll actually mean something. It means if you had no revenues come in after year end, how many days could you support your paying expenses as they're currently being incurred in the last year? And then the next slide talks about this qualitative disclosure. And again, these are your financial statements and you need to communicate your liquidity story. So here's an example of how other people could disclose this information. It talks about this organization has a goal to maintain their financial assets maybe on hand to meet 60 days of normal operating expenses. It talks about they have a goal of investing cash in excess of their daily requirements and investments. And it talks about a line of credit that they have, which could be drawn upon in the event of an unanticipated liquidity need. And this, as a side comment, just shows the importance of having a line of credit before you actually need it. And next slide. The financial statement readers could be a potential funder. And I've heard this footnote described as the Goldilocks principle. And so maybe the potential funder is looking at your organization and reads that first footnote, the quantitative, and they see that number there. And maybe that number, they're thinking that's really a large number. Maybe this organization doesn't need my contribution. Or maybe they're looking at the number and says, well, that looks pretty low. Or actually, it could actually be a negative number if you deduct those non-financial assets. They think, wow, is this a sinking ship? Or maybe it's mismanaged. Here, you want to make sure you determine the message you want to convey. So when your financial statements are still in draft form, take ownership of this footnote to tell your story, because the auditor only controls the auditor opinion. You can draft the statement. You want to be able to show you're working with your board, and you can add to this qualitative disclosure, say you have ample resources. Be sure to summarize your reserve policy, including if reserves are set aside for a future capital project, or if your organization struggles to maintain sufficient resources, disclose the action plan for covering these expenses. We talked about that line of credit that could be drawn upon, or maybe there's a large grant coming in the near term that after year end that you want to tell the reader about. Next slide, please. And here is the importance of this presentation talking about management considerations. Make sure we're disclosing this requirement to your board and discussing it with them. We're being consistent with board spending policies, investment policies, and board designations. We're identifying the best way to present this message, and we're discussing best practices of achieving transparency, because this will be part of your audit financial statements. And we know best practices to include your audit statements on the nonprofit's website. Next slide. So the readers of the financial statement and also your board need to know the what, how, and why, and how of how to account for nonprofit revenue. It's all very unique. It's only a little bit of it's similar to for-profit accounting. It's going to have a unique timing, valuation, and judgment. And we thought a good way to communicate this is actually a flow chart on the next slide. This is from an Accounting Standards Update 2018-08. Your first type of revenue could be an exchange revenue. And you may think a nonprofit doesn't have any exchange revenues, right? It's all contributions. But actually, if you think about membership revenue or gift shop revenue, there's an exchange element to that. And your board members may actually find that easier to understand because that's going to be like they're accounting in a for-profit entity. It's called Topic 606. Another example of funds coming in could be called an agency transaction. That means it's not actually revenue at all. It's a liability of cash coming in the door, say because a nonprofit needs to have discretion on the use of the funds. An example of this could be a church. Maybe they're making a collection. They say, this next collection is for the benefit of Habitat for Humanity. That is actually going to be recorded by the church as a liability because they don't have discretionary use of those funds. But if they make a similar ask for this was going to benefit the homeless, they will have discretion. It'll be the benefit of the organization, and those funds will actually be revenue to the church in that example. Let's say that it's going to be the transaction for a nonprofit, a non-reciprocal transaction. It's going to be contribution guidance. There's so many unique aspects here. It could be a non-cash contribution, like a contribution in kind. That would be recorded as revenue to the organization if someone gives a service that's a specialized skill, and the organization would actually purchase that if it had not been donated. A contribution could be verbal or in addition to being in writing, especially if it's a promise and not just an intention. There could be a condition attached to a contribution. Say, organization says, if you raise $50,000, I'll match it. And maybe they actually give you the $50,000 up front. Well, that cash will be a liability until you meet the condition of earning that revenue. And then we're very familiar with then restrictions by a donor. It could be by time or purpose. That's going to be revenue, but it's going to be in different classes of revenue, different classes of equity until you meet the intention of the donor. So a lot going on there. Again, just as a resource to come back to. Next slide, just other broad topics of unique non-for-profit accounting. If an organization has investments and endowments, this is going to be subject to the Uniform Prudent Management of Institutional Funds Act, or of MIFA. If you have two separate legal entities, it could be required to be consolidated for financial reporting purposes if there's a direct or indirect control and there's an economic interest. Another concept here, it's unique for non-for-profits, is that statement of functional expenses that we talked about is now required. You need to have a unique aspect of allocating these costs of indirect across program, G&A, and fundraising. We talked about disclosures for a nonprofit. There could be so much more that needs to be disclosed if an organization has conduit debt, and that's defined as a debt instrument issued by a state or local government. Your disclosure is going to be just like a for-profit, publicly traded entity like Apple. You can imagine how much disclosures that would really cause an organization to have. And another unique concept is taxes. Normally, you wouldn't expect to see taxes in a nonprofit financial statement, but they could be there if you're consolidated with a for-profit entity that you wholly own, or perhaps you have a program that competes with a for-profit entity and is regularly carried on. You would be subject to unrelated business income tax. An example of that could be a gift shop opportunity, a gift shop that's part of that exchange revenue that a nonprofit could have. And then the next slide. So our job is to use today's tips to help train our board members, to help them focus on potential red flags. And the key is, can they identify, with the help of management, if they're reviewing information presented by management in an easy to understand format, would they be able to say, hey, looks like there's a decrease in net assets from operations here. Let's talk about that a little bit more. Or maybe it looks like we're having insufficient working capital, or looks like a debt covenant violation, or gee, we've really been impacted by COVID-19. What can we do? Is there negative operating cash flow from operations? Do we have resources on hand to meet these restrictions by time or purpose by a donor? We talked about that day's cash on hand. What does that represent? That quantitative footnote, is it negative or pure low? And are they into the line of credit? And is that a potential danger sign as well? So there's a lot of information there, a lot of information to digest, but hopefully you can use this as a resource. And with that, I'll transfer to the third part of our agenda, hand it over to Greg Logan, who's going to now talk about budget preparation.
All right, thanks, Randy. A lot of good information there. And thank you, Kathy, for the introduction. I think in that slide that had our pictures on it, I was listed as the managing partner, and that's true. That's one of the hats I wear. I'm also an audit partner still over some of our nonprofit audits. And I'm also the partner that's over our outsourced accounting service. And we have a lot of nonprofit clients there. So I kind of have a lot of experience in it and a lot of different ways of serving nonprofits, which I like to think gives me a little bit of a unique perspective, because when we're doing work for our nonprofit audit clients, our nonprofit accounting clients, a lot of times we're involved from start to finish with the budgeting process, hands-on with the spreadsheets and acting as the accountants and pulling together all the information and working with management, and in some cases even presenting it to the board. So, you know, I hope that helps me try to give you some good advice today on the budgeting process. And even before we get to the slide, it kind of occurred to me during Randy's presentation about just the budgeting process and telling your story. I mean, it seems like a lot of times a nonprofit is challenged to try to make the financial information tell the story that you want it to tell. Like, well, here's my ratios. Well, what's the story I want to tell with it, right? But the budgeting process is maybe one of the few, if not the only time, you get to try to plan and try to force the numbers to tell the story you actually want it to tell, and not have to go the other way around. So it's kind of interesting. But what's kind of the big deal with the budgeting process? Sometimes I run into clients and I've seen a lot of things. I get some excuses. I get some reasons why maybe there's not a lot of focus on the budget process. Sometimes a nonprofit thinks they're just too small to need a budget. There's just not enough coming in and out. So why spend a lot of time on it? You know, it's pretty straightforward. Or maybe you don't have enough time to invest in the budget process. That I've seen a lot of small and mid-sized executive directors who are kind of in charge of the whole thing, and there's just too much going on. It takes too much time. Sometimes it's not about the nonprofit and the management at all, but more about the board, kind of like what Randy's talking about. If they're not trained or don't understand nonprofit accounting very well, they may not even look at the budget. They may not spend enough time on it trying to really understand it and analyze it, and aren't asking the right questions. So why spend a lot of time on the budget if no one's going to take it seriously? And sometimes it's just too hard to predict. I kind of imagine a lot of y'all probably spent a lot of time on the budget for 2020, and then 2020 actually happened and you just threw it right out the window. I mean, you put a lot of effort, you want it to help you, and then sometimes it just doesn't provide the desired impact of actually helping you guide the nonprofit's finances. But I think there are some things that can go wrong if you don't spend enough time on trying to put together a meaningful budget. One, you just really have that lack of accountability, whether it's over the spending of the nonprofit, or of management of the nonprofit, if the board isn't able to exercise its oversight over the finances of the nonprofit appropriately, which could lead to just failing to meet the strategic goals of the nonprofit. If there's no oversight and there's no good budget to kind of measure this, then ultimately you may not be able to achieve the financial goals that you want to. It really nullifies the role of the board in the whole finance aspect of a nonprofit. And ultimately, all this leads towards the potential that you'll just have an inappropriate allocation of resources of the nonprofit, whether it was just because you put together the budget and were spending money that just didn't really meet the goals of the nonprofit, or in some cases, just outright fraud. A good budget versus actual comparison, when you have a really well-prepared, meaningful budget, is one of the best ways that you can identify some anomalies in the spending of a nonprofit, some of which could be fraud. So going to the next slide, I'm kind of using this phrase, a meaningful budget. To me, if you really take the time to put together a meaningful budget, it really becomes a critical process for the nonprofit and can really help guide the organization financially and give you really the best information throughout the year to help make the best decisions possible. And again, it really provides the strongest monitoring tool for those charged with governance to try to hold the nonprofit accountable financially and fill that role. So in the next slide, we're going through, there's really only a couple of elements, I think, of a meaningful budget. The first one here is organizational buy-in. To get organizational buy-in, you're going to have to get as much input as possible from as many knowledgeable people as possible, and the board's going to have to participate in the actual preparation of the budget to an extent and in a certain way, and not just be the people that see it after it's been prepared and then you vote on it, and that's the first time that they've ever seen it. To me, if you approach it properly, you'll get organizational buy-in. So that's one element. In the next slide, the other element of a meaningful budget, I believe, is it simply has to be thoughtfully prepared. It's got to be based on good, accurate, historical accounting data. You have to have a good basis of numbers to start with. You have to really know and have a handle on the nonprofit and the environment so you can work in known changes to the organization's finances, programs, and things like that. And you also have to use a realistic basis for your assumptions about the year that you're doing the budget for. And I feel like a lot of times nonprofits start with the expenses. They put all the expenses they know they're going to need, expenses they want to be able to pay for, and they just kind of plug the revenue to say, well, that's my goal. Well, the expenses aren't necessarily the most realistic basis for the assumption on what revenue is actually going to be. And I think sometimes that stretch goal ends up being a challenge for the nonprofit to try to deal with when they realize, okay, we're not hitting the numbers that we hoped that we would hit. You have to have a realistic basis. And you really should analyze key performance drivers. It's a lot like a key performance indicator, where you can kind of look at historical data and come up with good metrics to see how you're performing. But you can actually find qualitative information about your nonprofit and things you're doing to try to help predict revenue a little bit better. For instance, if you're doing like a campaign mailer or something like that, and you can look at the past and see, well, we've done 10,000 mailers and that returned revenue of X. And if you have good data, you'll be able to look into the future and say, okay, well, this year I think we're doing 20, so I can reasonably predict what I think revenue is going to be from it. But the second element here, it just should be thoughtfully prepared and use as much good information as possible from as many people as possible. So how do you actually do this? So those are the elements of a meaningful budget. How do you actually get there? So for me, to achieve buy-in, like I said, you have to get input from a lot of different sources. The accountants have to provide accurate financial data. That's their role. That's what they've got to do. And if they do that and you actually take the information from them seriously, then they're going to want to buy in. Management, who actually knows the programs, the nonprofit, the environment that you're operating in, is going to have to provide all of that information about the program, changes they see coming, all of the analysis, all of those key performance drivers, and they've got to throw those on the table. And then the board has to play their part in the budget process and be sure to actually guide the nonprofit. What are the strategic goals? What part of our mission are we going to focus on this year? What do we need to do? And they have to make sure that what the accountants are providing and what management's providing, that it's all going to help be in alignment and have that budget actually work towards telling the story they want to tell and have that budget actually be in alignment with the goals of the nonprofit. So when everyone understands the importance of a meaningful budget and actually play a part to contribute to the creation of one, I really think the organization will achieve optimal buy-in. And then on the next slide, once you've actually got that optimal buy-in, I think everyone's going to be more eager to actually fill their role in guiding the organization's finances. accountants, knowing that the budget is being taken seriously, is going to help to control costs. It might even improve the accuracy in which they do their work, because they know someone's looking, someone's going to be doing these comparisons, and they know it's important to creating a good budget versus actual comparison at some point down the road. Management will have financial clarity on where the nonprofit stands. It'll empower them to make the best decisions possible and really help them stay on course, because they know the budget is there to guide them and fill the mission of the nonprofit. And finally, that board is going to have that tool that lets them provide that oversight, that accountability. You'll have good reports that they can read and understand that they were involved in putting together, and they're going to want to fill that role of asking the right questions and really trying to understand what's going on at the nonprofit. But what about the actual spreadsheet in Excel and getting the data? Like, how do you actually put this thing together? I've got a few slides here to kind of walk through kind of the way I think about it, logically, step by step, and how you prepare it. First thing here is, just having that P&L by month, that statement of activities by month, where you can actually analyze the real timing of the revenues and expenses of the nonprofit, and really dive into understanding the reason for these amounts and the fluctuations. I mean, that's step one, is starting with the real data from the last year. The next slide, you can layer in all these known changes to staffing, new programs, campaigns, adjustments to vendor contracts. You really have to take the time to analyze it and try to layer over all these known changes. And you can also take everything you learn from that historical analysis, the historical analysis, these key performance drivers, and all these other assumptions that you're putting together. And then you can really start layering in and projecting the revenue and the expenses, and hopefully having a successful attempt at trying to predict all of these items. And it's really important to document all these assumptions. Once you've put together your budget and you've started to edit it and tweak it and shape it into what you want it to do, be sure to document, why you came up with the numbers you came up with, so that if something changes, you can always tweak it and change it as necessary over the course of the year. And then, like I said, at a couple times now, before you get too far in that process and start doing what you want to do, what you hope to do, relevant board members should really be involved in the budget process, so that they can help, guide and make sure that the decisions that are being made about the allocation of spending are in alignment with the goals of the nonprofit. And that should be documented as well. But again, having them involved during the process, not just at the very end, is again going to help achieve that buy-in. But that'll also help make sure that you don't have to redo your work, and then everyone's going to vote yes once you get to the board meeting about the budget. So a couple more thoughts on this idea of the fact that this budget should be prepared with a monthly perspective, as opposed to just taking your annual revenue and divide by 12 and say, well, there it is. It's really going to optimize your budget versus actual reporting if you have it timed as accurately as possible throughout the year. It's going to provide that really meaningful report that you can ask real questions about why things aren't the way we thought that they were going to be. And here's where it also helps serve as a cash flow projection tool. When you have a monthly budget and you have a nice spreadsheet that you've worked hard on, you'll be able to take your actual numbers and plug them in month by month as the calendar turns. And then if you add in an element of having your ending cash balance at the end of each of those months, you actually have a really easy way to try to project what cash is going to do the rest of the year, month by month, based on how you projected these monthly balances to roll through the year. You might see a month that's going negative or is getting a little bit tight. You may want to pull on that line of credit, and it helps you predict that so that you can let your board know, hey, we're going to be short in September. We're going to have to pull on this, I think. And you can really keep everyone informed and use that to help manage your cash a little bit. So I've found that to be helpful in the past. A few quick final thoughts here, just on the budgeting process. I mentioned before, well, if you take that budget and you can kind of tweak it based on changes, especially for the cash flow projection aspect, that's not an amendment. So I wouldn't want to go and formally amend the budget every time you want to make a change or things aren't going exactly the way you thought it was going to go. You really shouldn't over amend the budget once or twice a year, and only when something really significant happens. So don't go crazy with that. Just also want to say that the budgeting process is kind of an art. It's not a science. I think the more you do it, the more you practice it, the better you get at these predictions, the better you are at spotting, the the things that are happening now that you can use to help you try to predict what's going to happen in the future is something that if you practice at it and kind of take it seriously, you can really get good at making a meaningful budget. That'll be a really useful tool. The final thought on this, it might be controversial, but don't avoid questions. I feel like a lot of nonprofits, their goal is to go into the board meeting and have the board not ask one question about the finances because they just don't want any questions. You just don't want to deal with it. I'd much rather have good information, accurate information, and if there's a variance that looks strange, simply be prepared for the question to be asked. Let the board do their job and be sure to answer it. In my opinion, that's usually the most beneficial way and the most educational way for everyone to kind of work together. So that's kind of all I had today on the budgeting process. I hope something in there was useful or interesting, and that hopefully you can be inspired to kind of work hard at making that meaningful budget here as we enter the end of the year here. So, but with that, I will kick it over to Nathan and we'll look at some of those metrics and graphs that we were talking about.
All right. Thank you, Greg and Randy, for saving the best for last. But really though, following their advice will set you up for success. And as Kathy mentioned, I am Nathan Lummis, audit partner, and I've been helping nonprofit and managers and boards understand their financial statements for about 15 years. And like Randy was saying, most nonprofit board members have a passion for their mission. And sometimes they forget that the organization is business-like and that the business side of measuring the nonprofit can take a back seat. Things in the back seat might be what Greg was talking about: key performance indicators, metrics, and ratios. Being able to present these in a way for all board members to understand is important to increase their understanding of the entity, operations, and the direction the nonprofit is heading. My goal here today is to give you the tools to help you tell your financial health, your performance, and your program's effectiveness to your board. It is important to note the indicators are just numbers. One thing to remember is a trend is your friend, and it's their direction that can help you navigate through dilemmas, adapt to issues, and make future decisions. Most of the time, these tools are going to be best used when looking at multiple years or compared against a benchmark you wish to attain. Sometimes these benchmarks can come from things like the BBB Wise Giving Alliance, Charity Navigator, Charity Watch, or GuideStar. All of these organizations are organizations that compare nonprofit data and store the data so that potential contributors can go there and find out more about your organization. There are multiple categories to monitor, which include fundraising, which is how you raise money, program delivery, which is how your services are being used, and financial, which is how well your company looks on paper. The first section we'll be covering is the fundraising, because many nonprofits rely upon contributions, grants, and donations and gifts in order to fund the mission of the organization. So if you can go to the next slide, monitoring these efforts can help you understand why the contributions have gone up or down over time. So the fundraising efficiency ratio will help you identify the amount of effort you are putting forward to attain funds. It is simply the total amount of fundraising expenses divided by the total amount of contributions that you've received. And this calculates how many dollars it takes to raise money. For example, if you raise $100 and it took 25 of fundraising effort, this would be a 25% ratio. Now, according to Charity Watch, which is the one that I was reviewing, to get an A rating there, this ratio would need to be 15% or lower. This is important because donors are concerned with how much of their donation goes to pay for the actual mission. And this is a high-level ratio that includes all fundraising effort. However, you don't let Charity Watch or other types of watchdogs be your only guide, because you could have a situation where you have a fundraising event that costs, that raises $200, but only costs $35 to run. And that's a 17.5% ratio. And that's a little higher than 15, but if you're earning more money for your organization, it might still be wise to run that fundraiser. So the ratio is just an identifier. You do have to compare it with other information. It would be valuable for you to know you can also compare fundraising events this way. You do have to gather that data for the 990 reporting. So you can figure out which one is more efficient and maybe which fundraisers you want to put more effort into. The next section is going to be about program delivery. And as mentioned above, most donors are concerned with how much money goes toward the program. Likewise, the board should care about this number as it is a good indication of money being spent toward programs, or at least being allocated to programs. So what it is when you take the total amount of expenses that are program related and then divide it by your total expenses. This is where nonprofits can say things like, for every $1, we spend 80 cents on our program. So for example, an 80% ratio would be you had a total expenses of $100,000 and you spent $80,000 of that $100,000 on your program or your mission. According to Charity Watch, again, to get an A rating, this would need to be 80% or higher. And you can also use this to evaluate your programs. So you can run each program and find out which ones are having more administrative expenses in nature. However, just like the fundraising efficiency ratio, these are only numbers, and you need to consider other factors when making decisions about these programs. Some programs are just going to cost more administratively, but if it's in line with your mission and they're helping more people, then you would want to continue to do that program because it's in line with your mission. Another trend that is important that's mentioned on this slide is the number of beneficiaries served. And this is when you look over the past years, you can identify how many people you've helped. If this is something you're looking and able to track, this is a good indication of how you're doing with your mission. So if your goal is to help more people over time, this number would be good to track. It'd also be good to display this information once you gather it, because potential and current donors would want to know this. And it can also help the board determine what programs to provide in the future. Now, the next slide is kind of where I live. This is the financial ratios. So these numbers come directly from the statements, mainly from the statement of financial position or the statement of activities, which are like the balance sheet and income statement. The current ratio is how many current assets you have, which are things that you're going to have access to within a year, which includes things like cash, receivables, and prepaids, and divide that number by the amount of current liabilities you have, which are things like accounts payable, accrued liabilities, maybe some salaries payable you owe at the end of the year, and all of these things you owe within 1 year. It does not include long-term loans. And a good example is if you have $100,000 of cash and $50,000 of accounts payable, then your current ratio would be 2 to 1. And that's actually the recommended ratio. The other ratio mentioned here is the debt ratio. This is how much of your assets are subject to long-term debt. Most nonprofits will do a capital campaign, raise a good amount of money, let's say $700,000, and then they'll take a loan for $300,000 and they'll buy a building for $1 million. And if those were your only assets and liabilities on the books at the time, you would have $300,000 in debt, $300,000 in debt, $1 million in total assets. So your ratio would be 0.3. And while contributors are not investors, they may still look at this ratio as a factor in their choice of nonprofit, because a highly leveraged nonprofit might be using a lot of their funds to pay off their debt. And what's interesting about that is paying off of debt does not show up on the expense side, and it doesn't show up as a program or administrative expense. So it's kind of sneaky. So that's why this ratio, people are going to look for it to be lower in order to help your solvency and also the opportunity to use the money for the purpose rather than paying off debt. Now, I've talked about all these ratios. Now it's time to talk about the presentation. So this slide is what I want to see as an auditor. So I'm looking at all the ratios all the time, trying to analyze everything, and I just want to see the data. However, if you just show this to a board, you're going to start to see their eyes glass over, just like maybe some of yours are starting to glass over right now. But you know, I like this format because I like accounting, but I know this is not the case for everyone. What I recommend is for you to take each one of these ratios and tell each one's story by creating one chart for each and then talking about that chart. So if you go to the next slide, this is the fundraising efficiency ratio that I was talking about earlier. So this entity had in 2017, there's various different colors on this chart. So one of them is total contributions, that's the gray. The orange is the fundraising, and the line is telling you the ratio. So the ratio is going up and then going back down and going back up. Well, they kind of have every 2 years, they throw an event. So they were throwing these events every 2 years. So this is actually what they would want to see. They would want to see an up and down and up and down and toward the future. Now, in the next slide, I'm going to show you the program delivery. So this is an interesting one. This is called an area graph. And the area graph is all the blue information is the program expenses. So this is how much of your mission that's happening in dollars. The orange is how much total expenses you've had, and the orange is including the blue. So at the very top of the orange, though, where you don't see the blue, that's how much extra expenses you had over your mission. And then the ratio is how is defined on the right. So the charts also, I forgot to mention this, the amounts are on the left, the bottom are the years, and on the far right is the ratio. So you can kind of have this, there's the ratio, there's all the data. It's very easy to see, very colorful. And if we go to the next slide, this is the amount of people helped. So this is just a simple bar graph to show you that in 2017, you were helping about 12 people, 2018, almost 30. But this is very visually compelling to where you can see how many people you're helping over time and you're doing something right. In the next slide, we've got the current ratio. Now, so the blue is how many assets you have. The orange is how many liabilities exist. And as you can see, they started decreasing some of their assets, paying off some of their current liabilities. And then in 2020, there was a refinance. So they got some long-term debt to pay off some current liabilities and buy some assets. So that was able to change their current ratio a little bit. All of these ratios are able to help in the budgeting process too, because you need to know where you've been in order to determine where you're going. The next slide, I think, is our final ratio. And this particular client had numerous amount of assets and a little bit of debt. And so I just wanted to show that here. Little debt is the blue line, and the amount of total assets is the top, and the ratio for debt is going over. And as you can see, the blue starts decreasing in 2020 because they started paying off their debt and bringing their ratio lower to where they would be more appealing for clients. But this information is really important for the board to understand in order to make decisions about budgets and goals and the future of the nonprofit's mission and how that mission gets accomplished. And I will thank you for your time.
I'll go Nathan, Greg, Randy, go in reverse. So we've heard about financial statements, we've heard about budgeting, and we've heard about using ratios and different methods to demonstrate your financial picture. So we thank our speakers. We thank you for joining us.